My name is Bill Mason from Mason & Mason. This is real estate from an attorney's perspective. Today I have Matt McEvoy, a loan originator with Lendgen, and he's going to talk to us about the top credit myths and facts. And I'm real happy to have him here with us today. I've been friends with, we were just saying, with Matt for about 20 years. Mm-hmm. And besides friends, we've done countless closings over the years. He actually did the closing on my house when I bought my house, and my vacation home, I think, too, right?
Yeah.
I'm happy to have Matt here to discuss credit because Matt's my figure it out guy. I got to be honest with you. I can't tell you how many times he'll look at a loan application with a guy and make it work in a legitimate, good way and really save the deal. And when he walked in today, we were just talking. We had another deal that was already in contract where it was just about to fall apart. And within a couple of days, it was a commitment letter. I really appreciate you doing that for both me and my client. Saved a lot of aggravation.
My pleasure.
And I really appreciate you being here. And maybe you could just tell us a little bit about yourself before we get started.
Been a mortgage banker, broker for 22 years now. So I knew you.
Yeah.
I knew you from the beginning. And just lending to residential, mainly do some commercial, but 1 to 4 family units, purchase business, refi business, and credit is something we run on every file.
Right, and something you know a lot about.
Yeah.
So I think the way I wanted to start off today was the question that everyone says, hey, I'm shopping for mortgage, and is it okay to run my credit? Like, is that going to mess me up? So maybe you could talk to that a little bit.
Very good question, and comes up every day. Myself, I don't want to just pull credit to just pull credit. Mm-hmm. And that's how I treat my borrowers is like, if we're looking for a pre-approval, we need something. There is something you can monitor, but you really should take advantage of looking at your credit for free with no inquiries at first. Just have an idea where your scores are. And then when you're looking to actually purchase, you do need to pull your credit.
So what does that mean by just take a look at your credit with no inquiries first? Like, what does that mean? Is that like what they call a softball, or what is that?
Yeah, the your major credit cards, some companies will offer free analysis of your credit.
Oh, so okay.
On your credit card statement to discover, sometimes if you opt in, they'll offer you your credit scores.
Okay.
Or one of your scores.
Okay, so at least you have an idea of where you stand.
Are you 600? Are you 700? Are you 800? 500? Then we have an idea, and if anything comes up, you know how to react right away.
And when you actually do pull the credit, though, does that affect your score each time someone does it? Or if I go to like 3 different banks and they all run my credit, is that going to hurt me, or is that going to matter? How do you look at that?
You want the long-winded answer or the bullet point? If you're going to pull your credit, you do it, and then you're not penalized to shop. So you should do it from another company and about 3 inquiries within a couple weeks. The first one will be a hard pull. The other ones will be hard pulls, but you won't have a decrease to your credit score each time.
Okay, so it's okay to do it.
It's okay to do it. If you get a credit card, get a mortgage, and then you apply for different types of credit and you pull your credit, they think you're not shopping. They think you're reaching for credit and not letting the other creditor know that you're getting credit. And that's the rule of why inquiries do hurt.
Ah, okay.
A little.
That's a good explanation. So when I'm shopping for a loan, it's all right to go to you and let you run the credit. But the big thing you don't want to do is shop around and then at the same time take additional other credit, right? Because that will hurt you. Take out a credit card or do something like that, right?
You look like you could be overextending, yes.
Okay. And so when you do, let's say, run the credit and you find like an error on it, incorrect late pay or somebody else's, how do you fix that? Like, what can you do? Is there a way to fix it quickly, or is it just over time, or how does that work?
Super important why we said monitor. Mm-hmm. So if you have a derogatory, a collection that pops up on your credit, a new debt, you'll see, if you're looking at your scores, you'll see my score bumped down 20 points. So why? If you had a 30-day late on a recent card show on your credit and you paid it on time, you immediately reach out and you can contact the creditor that reported it, or you can go through TransUnion, Equifax, and Experian, the three bureaus, and dispute it. And I
think I've seen you do that. How does that work? Because the reaching out to the creditor avenue is not quick, right? The way you do it, it's quick.
Yeah.
Or quicker.
Yeah. FACRA, the Fair Credit Reporting Act, allows you to dispute with TransUnion, Equifax, and Experian. All three are separate, and challenge it, something that's on your report. They go back to the creditor and they verify that it's true and accurate. Within 30 days, they need to give a decision.
So that's right. So basically, I've seen you do that, and that works pretty well, right?
Yeah.
Definitely gone down that road before.
Especially on older debt. Yeah, for sure. Something that's not yours, absolutely. Very quick.
Okay.
If you don't know what happened, you can dispute it. You're just asking, is this true and accurate? And they'll respond yes or no.
So that's a good thing to know, because ideally people should be monitoring their credit, but most don't. And I'd imagine most people, when they come in for that initial pre-approval, they don't really know that much, right? And so they're pretty much getting their credit pulled, and you're going to tell them now, hey, you're looking to buy a house, you got to fix this up. So that's a great way to, I guess, start to clean up their credit. By the time that they really have to close, you can get it to work for them, right?
Absolutely. Yeah. Your credit score we're talking about, you also need to look at the history and the depth. Some new credit borrowers will have a 800 score, but they just got one credit card. Sometimes you need to have some depth to the credit. So when you're looking to purchase, when you're looking to refi, and you're monitoring your scores and you have limited trade lines, there's more things that can fluctuate when you have an inquiry, let's say, and you only have one trade line. There's not that much credit depth, and those are things I can help with.
So let me ask, that's a good point. Like, I've had some people where they just don't use any credit cards, or they don't,
all cash.
Yeah. So how does that work? I mean, is there like alternative credit? Like they could show they pay their
question.
Like, what is that? How do you do that?
Alternative trade lines are absolutely a great way to establish credit, but there's nothing that will establish NA. You have no credit scores available. You cannot give me perfect mortgage history, perfect credit card payments, alternative. You have to have that minimum score, usually around the 600. And then you can, not to increase the scores, but for lending purposes, you could say, listen, I pay my rent perfectly for 12 months. It comes out of my account. Here's proof. And that's $3,000 a month. If the mortgage is, around, then that's a great way to show trade history. Doesn't increase your scores, but allows us to get the loan approved, knowing that you have alternative trade lines.
So they look at a bunch of things. So it's not just the credit score. So it's your credit score, it's, I guess, lates, and then it's the amount of credit or your history in credit, right?
Yeah.
And
paying
then,
back.
So those, and then there's a thing called credit, I think you call it credit utilization.
Yeah.
Right. And what is that? They want to see, maybe you explain it.
One of the best ways to really improve your scores immediately in that 30 days that we talked about is utilization. If you look at your revolving debts, not a mortgage, but your revolving debts, and you're allowed to borrow $1,000, let's say. Your balance is $900, but you pay it off each month. But when I look at your credit, it's $900, so you're considered maxed out. If you're allowed to borrow $1,000, you really want to be below a third, around 33%. $300 balance.
You want to have at least a third of your credit available. Is that what you're saying?
Three-quarters available.
Oh, okay.
Well,
so most of your credit available.
Right. On revolving trade lines.
Which would be what? A credit card, a HELOC, those types of things?
Not a HELOC, but yeah, credit
Credit
cards.
cards. Okay. All
Not
right.
installment loans. So if you get your balances below a third, then you'll see your utilization increase and your scores will increase.
Okay. So basically, credit utilization, having enough trade lines, right, that the bank feels comfortable with you, no lates, right? Is there anything else that they look at to like, or that you can do to make credit better, or, you know, that type of thing for somebody?
Yeah. There's authorized users, which is a great way to increase scores. Let's say you have very limited depth, but your family member, somebody has a card that they pay and you actually use, you can add your name on as an authorized user. So as long as that credit has been on the family member, that will show on your credit.
I think that's something people do a lot, right? I see you do.
Authorized user.
Yeah, yeah. And it doesn't work with Amex, somebody told me, though. Is that true?
No.
Yeah, so it has to be like a Visa or MasterCard, right?
Yes.
Yeah.
Yeah. That's pretty funny. You know that.
Yeah.
Amex is funny. They'll report differently, but your major creditors, and they'll always do it.
Yeah.
They want you in their ecosystem. So I can add you on my card as an authorized user. It's another person that's responsible of the debt.
Right.
But what happens is, as long as I've been paying perfectly, it shows on your credit.
Oh, let me ask you another question. This comes up a lot. If I've had a bankruptcy or a foreclosure or something like that, how long am I kind of out of the box to do anything? Is there like a period I have to wait, or what can I do with something like that?
A lot of people think 7 years. Okay?
That's actually what I thought.
When you're doing I will say, quick note is 2 years.
Oh, wow.
2 years outside of bankruptcy, you should be good to go.
Is that an FHA loan or a conventional loan? FHA.
FHA says 2 years from the discharge date on a Chapter 7. A Chapter 13, you can actually, with the court's okay, you can refinance or you can purchase with it. You could pay it off, or you can actually close on a loan with being in 13, with the okay from the court.
Wow. Have you ever done that? Because I've never seen that before.
I have done a refinance where I paid off the Chapter 13. Because Chapter 13 is you're agreeing to pay the debts, you're on a schedule. If you have 12 months of on-time payments with the courts, they give you the okay, you can actually pay it off. I have closed that before.
Whoa. I never even heard of that.
Yeah.
And that's an FHA loan, or?
That's an FHA.
So that's a conventional, not like one of these hard money loans, like just.
It's government-backed loan. You can do 96.5% financing. There might be limitations from lender to lender on if you're paying it off. Maybe you need to put down 5%. Maybe they'll require. FHA doesn't have their minimum FICO score is 500, but most lenders will have like a minimum of 580. We have a minimum of 580. We'll go 600, no questions. Below 600 to 580 credit score, we'll then need compensating factors.
Wow. So 2 years for Chapter 7 bankruptcy.
2 years.
And basically you can be in bankruptcy. I mean, I'm sure you have to get a release from the automatic stay as part of it, like you said, for the approval.
Yep.
And refinance. Wow, that's amazing. I never
Yeah.
would have thought that.
Conventional is 4 years. But 2 years with extenuating circumstances.
Wow.
Extenuating circumstances goes back to what we talked about with not just the credit score, but your credit depth.
And then, like, you know, like people, like they miss a credit card payment, or like how bad is that? Like, you know, people do it, you know, they have a 30-day late, or I know that there's a threshold on your mortgage if you go, I think 120 days. Was that, I think, what it is, that it becomes more serious? Like, how do those things like factor in?
If you know you're going to go 30 days late, just call. Sometimes you can call a creditor and say, hey, I'm going to get paid on the 1st. I didn't pay last month, so before you go 30 days late, call them. They might give you a grace period and not mark you late. When I'm doing a loan, when we pull credit, it's good for 120 days. But we need to look back to make sure there's no new activity. So I've seen files where somebody went a 30-day late, He said it was only a $30 minimum payment,
Yeah.
right? And that, if credit expired and we needed to pull new credit, that could hurt and actually damage, make a loan not close that was ready to go.
Right. That's good advice. If, I didn't think you could do that. So you could call the creditor and say, hey, listen, I know I'm late. Don't put it in my credit. I'm going to make the payment in 2 weeks, and they may entertain it.
Most creditors will absolutely work with you.
Wow, that's good advice.
Yeah, because that little 30-day late could throw 20, 30 points off. It depends on how deep your credit is. If that's your one card and you have a recent 30, you're going to see maybe a 50, 60 point swing.
That's crazy.
So just reach out.
On the mortgage, is there like what I was starting to get at before, is there a certain period of time, even if it's not in foreclosure, that you're pretty much in trouble? Is it 4 months or 3 months?
Oh, yeah. Our defaults are 60 days.
On mortgages.
So when we see a mortgage that's 60 days late in the last 12 months, it's usually going to be an issue. You went into default.
Can you get past that, or how does that work?
We will run an AUS where we'll be able to tell you whether or not we're good or not.
What's an AUS?
Automated underwriting system. So Fannie and Freddie both have theirs. So when I'm pre-approving somebody, instead of just getting their credit score, telling me their income, you really need a pre-approval. When you look at the documents, you actually look at your W-2s, your pay stubs that the client sent. You look at the credit and then you run it. And if it works, it works. Sometimes you really should be doing that before you're looking at a property.
Right. So that, I think I've seen you do that before. So I think I call it DU or something like that. But basically you submit the application, you almost have a forward commitment so that people can feel confident, right?
Exactly.
Yeah, that's a great thing.
It's a great tool to use to listing agents to say, here's the DU approval. That's pretty much, we're approving you.
Yeah.
Get these conditions in, we'll close. And that should be ran every single time. Sometimes borrowers putting down 50%, they have the money in the bank, they have an 800 score. I review all documents, but I'm not going to run a DU on that file if I know it's perfect. Doing this a long time, I know whether or not it will work or not. Some of those tighter files, you need to, like the one you mentioned earlier that we got approved when somebody had an issue with it, you have to get even more detailed into getting that DU, which is Fannie Mae's AUS, getting that answer right away.
And for people like that either want to not be on, like they can't be on the note, like a husband and wife, let's say the wife has bad credit or whatever, you can run the credit and only have one of the people borrow the money, right? You guys are okay with that. I think it's called the non-obligated borrower. Something we see a lot is we have a lot of doctor clients and they don't want to be on the title.
Okay.
Is that something you guys could do too? Like he'll guarantee, but he'll want only his wife on the title. The opposite. Is that something that could be worked out as well?
Yes, both scenarios.
Right.
So you can be on the mortgage and not be on the deed. You can be on the deed, not on the mortgage.
And when you have a guarantor on the loan, I mean, if I go on the loan and I have to put somebody else to help me get along, does that affect my credit score or no? It just makes it, how does that work?
When we are looking for co-signers, it's because maybe the borrower's income the debt to income ratio didn't cover the mortgage obligation. That's mainly why we're adding somebody as a co-signer or a co-borrower. It will not affect, let's say it's your loan, it will not increase your credit scores by adding somebody on the mortgage with you. It'll just use their income and their assets to help approve the debt to income.
So it's a DTI issue.
That's it.
Right. Okay.
Yeah.
And just one final question. So a lot of times people they'll be like, well, what's the minimum credit score I need, or what's good credit? Like, so when someone comes in, what are you ideally looking for to be like, let's say an A borrower, and what is like the threshold that you can't go below to lend money?
800 is perfect in our world if you're monitoring your scores. But with pricing, I haven't seen much of an add-on if you're over 740, that's the best of the best.
So that's a good point. So there's add-ons to the rate if your credit's at a certain score, right?
20-point intervals.
Wow.
640, 620, and so on and so forth. Each 20 points can be an add-on to the rate, can be a higher rate. Okay. So a lot of times when I have somebody that's a 690 score, they don't want my credit help. I'm going to give it to them and say, listen, there's 2 cards on here. It's $500. Pay these down before the statement date, because that's when they report to credit. Before the statement date, and the next statement, it'll show on your credit, your scores will go up over 700. Not only do we get the loan, but we're getting a better rate. That's
great. And so on the flip side, where's the threshold where you can't do it?
580, below 580, you can't do it. Wow. If they're 570, 560, there's ways to improve credit, like we talked about. If you have a 400, you're going to have to hire help. You're going to have to really find there's more going on than just paying down a couple debts below. You know, there's some deep credit analysis that has to be done and removed. So I usually see if you're in the mid 500s, there's a way to get you lendable up to the 580, 600 score. If you're in the 400s, I will look at it, right? But I will point them in the direction to where, you know, maybe somebody else could help you over a 6-month period of time improve. Everybody can improve the scores. It's the length of time it takes.
Right. I definitely have seen over the years together where we've had a client and he's been working with you for a few months and you've gotten him to where he could buy the house, you know, and that's pretty amazing, you know. So I think one takeaway from this would definitely be if you're thinking about refinancing or you're thinking about buying a house, there's such a benefit in meeting with the loan officer in advance. Like he should be your first stop so that you can get an idea of what you can afford, you know, and what you need to do to go forward. And if you have some 100%. Problems, meet with a guy like you and figure out how you're going to structure it and make it work, you know. And I think that's like probably the best thing you can do before you meet with anybody.
Yes.
And, you know, I said this at the beginning, I think you're a master at figuring out the deal. I can't tell you how many times you've saved deals for us, and it's great. But
thank you.
Well, with that said, can you just tell everybody how they could get in touch with you, and you know, like probably help some people out over here? And
you can reach me at my direct phone number 516-498-7602. I will have a QR code down in the description. You can email me at mmcevoy@lendgen.com.
My name's Bill Mason from Mason & Mason. This is Matt McEvoy from Lendgen. Either one of us would be happy to discuss anything we talked about with you further today or any mortgage-related topic. It's something that we both deal with on a daily basis. Please don't hesitate to reach out to us. As Matt said, both of our information will be in the show notes. And if any of you would like to come on the show, you're a mortgage originator or a realtor or anybody in the real estate industry, please reach out to me. I'd love to speak to you. Thanks very much.